Before we start this video, do like and subscribe to our channel and not miss on any updates.
Let us say you want to start a business, a company. What would be the first question to you? Definitely, what kind of a company it is? What type of business are you going to start, or do you want to start? Is it a textile business, or it is a manufacturing concern, or is it a construction company, or you want to trade? And what is the basic nature of the business? In other words, now coming into the technical part of it, the question would be, where do you want to invest your money into? So this is called as the investment decision. Now comes the next question. Okay, you want to start some kind of a company. Then how do you want to raise the money for this? Where is the source of finance for this company? Is it by virtue of equity? Do you have some set of owners who are interested in investing in the company, or you want to borrow some money, or you want to raise some preference share capital, or suppose you have been running for a period of time, then you already have some retained earnings with you which you want to use as a source of capital. Then what is the kind of source of capital? This is called as the financing decision. Now this investment or financing decisions are not just at the beginning of the company. As we all know, a company is a going concern. The actual game of financial management also starts not just when the company incorporates, but when the business runs. So as the company passes on, there will be a very crucial role which has to be taken by the finance manager by virtue of making all these decisions. And as the company goes forward, definitely when the company makes some profit, the company has to decide whether the company has to retain the profits or give away, which is called as the dividend decisions. Therefore, the structure of financial management, once again I would say, is a chain or a combination of these three important decisions. Now what is the meaning of financial management? Say for example, there comes a question which is posed as elucidate or explain financial management. It is very simple. By this time you should definitely be able to understand and explain, saying that financial management means management of finance, or financial management comprises of all activities with respect to raising funds to application of funds, or in other words, it is an integrated decision making process which is concerned with the acquiring, broadcasting, controlling, coordinating, directing, decision making, efficiently utilizing, forecasting, monitoring, negotiating, organizing and planning of all the financial resources for the purpose of accomplishing the final objective of the company. Now I think this sounds too long a list to remember. Let's do one thing, let's plan an acronym for this. Let's list down all these verbs in the form of A, B, C, D, E, F, M, N, O, P to explain financial management. What is this? A stands for acquiring, B for broadcasting, C for controlling or coordinating, D for directing, E for efficiently utilizing, F for forecasting, M for monitoring, N for negotiating, O for organizing and P for planning the financial resources to meet or accomplish the objectives of the business. Now comes the next point, the two main aspects of finance function. As we said, the two most important aspects of finance are, one, to get the money, and two, to put the money. So in a common man language, it is getting money and putting money, but technically speaking, these phrases don't sound that nice. So to put it a little polished, we should say procurement of funds and utilization of funds. Now it is not simply procurement of funds, it is procurement of funds in a strategic way. Now how does this procurement happen? As we said, procurement can be done by way of equity or preference or bonds or some term loans. These are the general major sources of finance. Now in addition to this, company can also raise some finance from the banks and financial institutions, which can be again either fund based or non-fund based, like guarantees or letter of credit. And then it can also have the finances given from some special sources. There can be some special models like venture capital funding or angel financing. Now all these modes have developed in the recent times to encourage the investors' ideas. And apart from these, we also have some bonds which are very special in nature. We'll have a detailed study about all these different types of sources of finance in the next chapter called types of financing. Now one very important point what should be kept in mind when we talk about procurement of funds is the cost of capital. As we said, each source of capital will definitely have a cost, and this cost should be very carefully analyzed because the overall cost of capital should not be very high. It's a very simple point. No, the common sense says, for example, if I have to buy this shirt and I know the worth of the shirt is 1000 rupees. Now would anybody be interested to buy the shirt for more than 1000 rupees? Definitely not, and you would be even more happy to get the shirt for about 300-400 rupees, because the lower you spend or the lower is the cost, the happier we are. in the same way, when you procure funds, we must definitely make sure the cost of raising the capital is minimum. Now comes the second aspect, that is utilization of funds, and we said it is not again simply utilization, it is effective utilization of funds. The role of finance manager does not end just by procuring the funds. He must make sure all the funds are properly utilized, and careful investment of fund does not mean only in the fixed assets. He must also decide upon how much has to be segregated for the purpose of working capital, that is the day-to-day running of the business. So it has to be very carefully segregated so that there will not be a cash crunch or any shortage of funds at any point of time during the year. Now apart from this, one another special point is the finance manager has to make sure the rate of return which is expected to generate should and must be over and above the cost. Friends, otherwise there is no point in doing the business. When the return is less than the cost, when you end up in losses, what is the point of doing a business? Definitely no. So there should be a very cautious eye on making sure that the return is over and above the cost. And the last and also the most important point is having a special focus on idle funds. Now in the process of allocating or segregating the funds, there may be some funds which may be kept idle for a while. Now the shareholders may start complaining, saying that the funds are kept idle for a so long time, and had they been given to the investors instead, they might have utilized them for some other purpose. Now this type of idle funds are said to generate an opportunity cost. So instead of say about 10 lakhs being kept with the company as a cash balance for about 1 year, had they at least invested that in a bank, it could have generated a minimum return of 6 or 7%. So this cash which is kept for about a year is called as an idle fund. Therefore the manager also has to have a special eye on these idle funds so that there are no much idle funds kept with the company. Now let's move to the next point, that is understanding the three main characteristic features of sources of finance. Now we said there are majorly two types of sources of finance. One is the own fund, the other is the loan fund. Own fund, in other words the equity, and loan fund, that is the debt. Now between these two funds there is one more fund which has the features of both own and loan funds, that is the preference share capital. Now taking these three as the base, let us analyze and understand three major characteristic features, that is risk, cost and control. Let's start with risk for equity. Now equity share capital, is it expected to be repaid? Definitely not. And is there any mandate to pay a dividend for equity share capital? This is also not mandatory. Therefore, the risk associated with equity is said to be the least out of all the three. Now come down to the loan funds. The loan which is borrowed has to be definitely repaid within a time. In addition to this, there is an interest component also which has to be periodically addressed. Therefore, the risk is really high with this component, because if the capital or even the interest is not paid, definitely there is a problem. There is a risk of non-payment of either of the two. Hence, loan funds are said to be highly risky. Now in between these two there is preference share capital. Now preference share capital is something like again a loan fund which has to be repaid after a time. Also the payment of dividend is not mandatory every year, just like interest. Only when there are profits the preferential dividends are expected to be paid. Hence the risk associated with preference is said to be medium. This is about the risk component. Now coming to the cost component. Okay, we just mentioned that debt has a cost, that is the interest. So interest has to be paid. Now tell me, there is a mandate for the interest to be paid. Is there a mandate for a dividend to be paid? Definitely no. So what we primarily think, equity is again the least expensive. This is a major mistake. Now friends, just understand, a person who just lent you money for your business is expecting about say 10-12%. Do you think the person who is a part of the company, who has waited so long for the success of the company, who has not taken dividends all the time, expecting a success, expecting a bigger profit for the company, do you think even the owner will be happy with this 10-12-15%? Definitely not. The expected return of the owner, the equity shareholder, is definitely much higher. Therefore, the expected return on one side is nothing but the cost for the company. Hence, we can say the cost of equity is rather the highest of all the three, and the cost of debt is the least. Again, the preference fall in between these two categories. Now, coming to the last component, that is control. Control here refers to dilution of control. What is dilution of control? Now, see, if the equity base increases, now there will be more and more people to decide upon. Therefore, the decision making power of the company gets diluted. So, instead of 2 or 4 people to decide, as the number increases, as the base increases, therefore, there will be too many minds to decide upon. Therefore, the control is diluted. Whereas, in case of loan, even if the loan increases, these people do not have any voting rights. They do not have the power to decide upon the affairs of the company. Hence, there is no dilution of control when it comes to loan funds. Now, between this equity and debt, there is again preference. Now, what happens in case of preference share capital? They are not given any voting power primarily unless they are not paid dividends for 3 years. Hence, again even dilution is neither high nor low. It is again medium for preference share capital. So, these are the characteristic features of risk, cost and control for the 3 sources of finance. And the next point is evolution of finance function. The evolution of financial management can be seen in 3 different stages: the traditional stage, the transitional stage and the modern stage. As the name suggests, in the traditional stage, the requirement of finance was very minimal. Hardly it was used in the occasions like mergers, takeovers and liquidations and all that stuff. But during the transition phase, the importance of finance has gradually improved and the financial management techniques were practiced on a very regular basis. Financial analysis and planning were given a higher importance compared to the previous phase. And coming into the last phase, that is the modern phase, the current phase, the role of financial management has drastically improved. The techniques used in ratio analysis is highly helpful for the decision making processes. Hence, there are so many theories and techniques and tools which have been developed in this phase and all of them are brought into practice. We will be seeing all those techniques very soon in the near future in those chapters. Now, let us move to the next point and the most important point of the chapter, that is objective of financial management. Now, what can be the objective of financial management? In other words, primarily, what is the objective of doing a business? Absolutely, but naturally it is to make profit. Therefore, profitability or profit maximization is called as one of the primary objectives of financial management. But let me pause here. It is only one of the primary objectives, but it is not the end objective. This is because even profit maximization has some discrepancies. Let us see all the discrepancies one by one. Totally, there are 5 discrepancies. The first one is the term profit being vague. The second one is the risk factor being ignored. The third one is time value of money ignored. The fourth one is social obligations being ignored. And the last one is consideration of different accounting policies. Let us see one by one. We said the term profit is vague. This is because when we say profit, it may refer to a short term profit or a long term profit. It could be rate of profit or value of profit. It may also be profit before tax or profit after tax. There is no clarity as such to which term profit exactly refers to. Coming to the second point, we said profit, it ignores the risk factor. Friends, let us understand that whenever there is any proposal or a project which is highly profitable, inherently there would be a high amount of risk involved in that proposal, which means if we say we are picking up a proposal which is highly profitable, it also means we are welcoming a high risk. Hence, just by deciding on the basis of a highly profitable number, we are ignoring the fact of the risk involved in that proposal. Coming to the next one, ignoring the time value of money. Say there are 2 proposals A and B, where proposal A will make about 20,000 rupees profit and proposal B will make about 30,000 rupees profit. Do you think we will have to pick up proposal B? Friends, let us go a little beyond and then check when are the profits being generated. Now say this 30,000 rupees is generated after 5 years or 10 years, and just because the number is higher than 20,000 which is generated tomorrow, do you think we will pick up the project proposal B? Definitely not. the 30,000 after 5 or 10 years is much lesser than 20,000 what we earn tomorrow. Hence, the very name profit also ignores the time pattern of profit or the time value of money. The next one is ignoring the social obligations. Just in the name of running behind earning higher number of profits, we tend to ignore the interest of our employees, our consumers and the society as a whole. Now, to keep in all their interest into considerations, having a higher profit would definitely not be appreciable. Coming to the last point, that is considering different accounting policies. Now, based on the accounting policy also, profit may differ. For example, if the company follows a WDV depreciation method, the profit will be different, and if the company follows a straight line method, the profit can be different. Hence, based on the accounting policy also, there can be an ambiguity in identifying the profit. The next objective of financial management is wealth maximization. That is, the firm has to focus more on the maximization of value or its wealth, which is denoted by the market price per share. It is nothing but the present value of benefits over and above the costs. Now, this concept of wealth maximization or the objective of wealth maximization also takes into account the present as well as the future prospective earnings, the timing and the risk associated with this earnings, the dividend policy and all the other factors which are very important for the market price of the stock. In addition to these factors, the discrepancies of profit maximization is also cleared in wealth maximization. That is, the term wealth maximization or the term wealth is not at all ambiguous. It directly refers to the market price per share. It does not have to fear about the risk factor or the time value of money, because both are considered. Only when the social obligations are met, the market price can be higher. Therefore, even this problem is resolved. And lastly, unlike profit, the cash flow or the absolute value is not dependent upon the accounting policy. Hence, we can conclude saying that wealth maximization is a much better objective than profit maximization. Now that we understood that wealth maximization is a superior objective, the next question would be how to attain this wealth maximization. Now, what would be the decisions to make sure we are maximizing the wealth? Now, to answer this question, we will talk about the three major decisions in financial management. Now, putting in the sequence, there would be financing decision, investment decision and dividend decision. To start with financing decision, what happens in financing decision? Now, for the company, there are some sources of capital required. It can be equity, preference, debt. So, what is the cost associated with each capital? And also, what will be the overall cost of capital? There has to be a careful check on this. In addition to this, the capital mixture is also very important, because we saw there are some characteristic features for each source of capital. Therefore, the risk component and the cost component should also be kept in mind, and at the end it should be made sure that the overall cost is not very high, it is as low as possible. So, this is about the financing decision part. Now, coming to the investment decision. Now, what is investment decision? As we said, it is the decision to be made by virtue of the investments for the company to be made. Now, the investments can be in two parts, one in the non-current assets and two in the current assets. Now, when we talk about non-current assets, it can extend from purchase of a pin to purchase of a company. It can be buying a machinery to that of a factory. And also, there is an equally importance given to the investment in working capital, that is in the current assets. The company should make sure it is properly investing in current assets, that is investment in stock, debtors and cash, so that the current assets are sufficient to address the current liabilities. Now, if at all there is a problem in judging this investment, there will be a problem of financial distress. Now, we have seen these two decisions independently, but do you think they are separate? Definitely not. There is an interrelationship between these two decisions. Why? Because the investment decision will generate a return, and the company has to make sure the prospective return which is expected out of the investment should definitely be over and above the cost. So, this is the relationship between financing and investment decision. Now, let's move to the third decision, that is the dividend decision. Now, having made the investment, we said the returns should be more than the cost. Now, when the returns are more than cost, definitely there will be a fruit, that is called profit. Now, what should be done with this profit? The profit basically belongs to the owners. Therefore, should the profit be given away completely to the owners, or can the profit again act as a source of capital and become a part of financing decision? So, now you can see a chain between the financing, investment, dividend decision and dividend and financing decision. So, this is a very important sequence which has to be followed. Now comes the next question, friends. if at all there is a problem in making the right decision by virtue of these three. We just said there is a situation of financial distress. Now, what is financial distress? It is a situation wherein the inflows are not enough or sufficient to address the obligations. For example, there is some cash which is left out with the company and there is a due for the interest payment. Now, if the interest payment is much higher than the cash available with the company, and if this situation continues, it is called as financial distress. Now, if this financial distress also continues for a while, it can also lead to insolvency. There is a saying in English which says, if the illness is untreated, it turns into a disease, and if the disease is uncured, it causes death. In the same way, if the company is not treating properly the financial distress, it may result into insolvency. So, this is a story of the important decisions of financial management. Now, the next point of discussion would be, what are the major functions of a finance executive? It is just an extension of the three major decisions what we just spoke about. Now, there will be a list of functions what we majorly see. The first would be estimation of fund requirement, then the financing decision, the investment decision, the dividend decision, the cash management decision, the performance evaluation, negotiations, and finally the market impact analysis. Let's start one by one. The first one is estimation of fund requirement. Now, as the very title says, the finance executive has to know what is the exact amount of fund which is required and what is the timing of requirement. Now, say for example, the company totally requires about 10 crores and it is not necessary that the entire 10 crores is required on the day one. Therefore, there should be a proper channelization of timing also. So, based on the nature of the company may go for a bridge finance. So, this decision is also very, very important, which the finance manager has to take. Moving to the second one, that is the financing decision, which we already spoke about. It talks about the various sources of capital, the cost of each capital, the capital mixture, and what will be the usage and how should these long-term funds be used for the long-term assets, the short-term funds be used for the short-term assets. All these decisions will be taken in the financing decision. The next one is the investment decision. Here again we will talk about how to invest and how much to invest and where to invest and whether to invest or not is the decision we will be taking here. This investment again talks about investment in the non-current assets as well as in the working capital. One important point, as we said, here should be the estimated return should be more than the cost, and the company should also make sure there are no idle funds kept with the company. The next decision is just the extension of this decision, that is the cash management decision. Now, this again depends upon the nature and the speed of operations. Now, how much cash should be disbursed to each department, section, branch, depending upon the speed of happening of transactions is again a very important decision, because there should not be a situation where the company falls or has a cash crunch. The next decision is the performance evaluation. Now, having taken all these major decisions, the first check should be the evaluation of performance. Now, how does this happen? This happens by virtue of a few techniques, or we will call it as the analysis and interpretation of financial statements. There are some techniques like the comparative statements, the common base statements, ratio analysis, cash flow statements and fund flow statements. So, with the help of all these things, the company can understand as to where the company is standing, be it by comparing with the past year or by comparing it with other companies in the same industry line. The next point is negotiation. The finance manager plays a very prominent role in negotiating, be it with banks, be it with financial institutions, be it with the suppliers, creditors or whoever. It involves a good amount of skill set to negotiate with all these people so that the company does not end up in having a huge cost. The last element is the market impact analysis. Now, apart from having or making all these internal decisions and then checking all things internally, the company also has to parallelly make sure what are the market trends. To be even more precise, the finance manager should be in regular touch with the market and should observe how the trends are actually going in the market and how the stock prices are fluctuating, because the final objective of the company is wealth maximization, which happens only through the market price of the share. Now, let's move on to the next point, that is, what is the role of a CFO present when compared to that of the past? What a CFO used to do and what a CFO does now. When it comes to budgeting, the role remains to be the same with respect to forecasting also. But previously, CFO used to do the accounting part, whereas now his role has improved to that of managing mergers and amalgamations also. Previously, a CFO was considered more as a treasury manager, but now he is considered to make the profitability analysis. Previously, CFO used to prepare the internal financial reports for management, but now he is again into the decision making and analyzing or making the pricing analysis. Previously, CFO used to prepare the quarterly and annual filings for the investors. Now he is completely into decisions about outsourcing them. Previously, CFO used to make the tax filings, and now he is into overseeing the IT function. Previously, CFO used to track the accounts payable and accounts receivable. Now he is into overseeing the HR function. Previously, CFO used to manage the travel and entertainment expense, but now he is more into strategic planning, regulatory compliance and risk management. Now let's move to the next point, that is the interrelationship between finance function and the other functions. Majorly we will be talking about the relationship between finance with that of marketing, production and accounting. Now when it comes to production, as and when the production increases or say the line of production changes, definitely it is a major decision by virtue of the investment. Therefore, the decisions of financial management will creep in there. From the examination point of view, the main question would be the relationship between finance and accounting. There are a list of 6 points to mention these comparisons. Let's take the help of another acronym for this. Let's talk about the FAT rule. Now what is this the FAT rule? Okay, THEFAT. So these are the 6 alphabets with which we can expand the points and understand what they are. T, tasks handled. When it comes to financial accounting, it is more of recording or procuring the data, but when it comes to financial management, it is more of procurement of funds and application of funds. This is about T. H talks about the hierarchy. Now financial accounting as per hierarchy is either a medium level or a lower level, but financial management is considered as a higher level. E, effect of decision. The effect of the financial accounting would be more on the profit maximization, whereas the effect of the decisions taken by the financial managers will be more on wealth maximization. Coming to the next one, F, the function. So in financial accounting, the function is more of measurement of funds, whereas in financial management, it is management of funds. Then A, it talks about in financial accounting, it is on accrual basis, whereas financial management, it is on actual cash basis. And the last one, that is T, with respect to time. Financial accounting talks more about the past events, whereas financial management is futuristic in approach. It helps us to understand more about the future events. Now comes the last point in this chapter, that is the agency problem and agency cost. Now what is this agency problem and agency cost? Well, generally in a proprietorship firm or in a partnership firm, the participants are the decision makers. That is, the members are the decision makers, that is, the owners are the management. But when it comes to a corporate, when it comes to a company, it is very, very clear by virtue of a corporate wheel that the owners are different and the management is different. Now this concept of these two people being different brings in a similarity to that of a principal-agent relationship. Yes, the owners are considered as the principal and the managers who take the decisions are considered as the agents. Now this results in a problem called an agency problem, which is nothing but, as we mentioned earlier, these managers who are the decision makers, they will be more keen on their personal goals in accomplishing their targets by virtue of having higher profits and getting more salaries and perks. Then who will address the interest of the actual owners? So this problem, which is between these principal and the agent, is called as the agency problem. Now to address this agency problem, the owners may have to incur a cost called agency cost. Now this cost may be by virtue of encouraging them to have more focus on the owner's wealth also, or monitoring them, bonding them and making sure all the targets of the company by virtue of all the groups are fulfilled. So this is the concept of agency problem and agency cost. So friends, this is all about the nature, objective and scope of financial management. So let's have a small recap of what we learnt in this chapter, all the 10 points. To start with, number 1, the introduction and meaning of financial management. We understood what is financial management, the meaning of financial management. We had an acronym A, B, C, D, E, F, M and OP to explain what financial management is. Then we moved on to 2 main aspects of financial management, that is procurement of funds and effective utilization of funds. The third point being, what are the 3 characteristic features of sources of funds, the 3 major characteristic features, that is the risk, cost and control. Then we moved on to the 3 stages of evolution of financial management, that is the traditional stage, transitional stage and the model stage. Then we move to the next and the most important point, that is the objectives of financial management, profit maximization and wealth maximization, and also we saw that wealth maximization is superior to profit maximization. And then we move to the next concept, that is the three major decisions in financial management: the financing decision, investment decision and dividend decision, and the interrelationship between or among these three decisions. And we also saw what happens if we do not follow these decisions properly, which may result into financial distress and financial insolvency. Then we moved into the functions of finance manager, and then we also saw the role of finance manager in today's world when compared to that of the past. And next we moved into the interrelationship between finance function with that of marketing, production and most importantly financial accounting. And lastly we understood the concept of agency and agency cost. So this is all about the chapter, and I hope it is conceptually clear, and I definitely understand being the first chapter you might have some dots throughout this content, but definitely as we further proceed all these dots will be cleared as we start swimming deep into the subject of financial management.